Hello, and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like West Virginia to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are reviewing how to move your existing limited liability company or corporation out of West Virginia to a new state to avail yourself of tax benefits, among other advantages. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, onward. West Virginia ranks in 32nd place, that's number 32, on the Tax Foundation's most recent State Tax Competitiveness Index. It's not the best, it's not the worst, it is in what I call the mediocre middle. The Tax Foundation, in its report, describes the state as having some competitive elements and others that could use improvement, and that's something of an understatement. In fact, that is a generous characterization of a tax code that sits in the bottom half of the country with a corporate rate above the national average, local gross receipts taxes, which are extremely unfavorable to small and medium-sized business owners, and one of the highest per capita debt loads of any state, which shows storms on the horizon, at least metaphorically speaking. West Virginia's individual income tax rate has a top marginal rate of 4.82%, recently reduced from higher levels, so we will give them credit for that. But that's still a lot higher than zero, but I'm getting ahead of myself. The West Virginia legislature has adopted revenue triggers that will continue to phase in rate reductions, subject, however, to revenue availability, which is lawyer speak for good luck. That may never happen. The stated ambition is to eliminate the individual income tax, and that is a laudable goal. That is the right destination. The rate reductions, however, are contingent. They're not guaranteed. They are contingent on revenue growth, and West Virginia's economy is headed in the wrong direction and is not generating the quality and magnitude of growth that would accelerate those phase outs. The state has one of the highest out migration rates in the United States. That is to say, the population is declining. The economic base is concentrated in energy extraction, principally coal and natural gas, which ties the state's fiscal health to commodity prices that the state cannot control. Revenue triggers that depend on growth do not trigger in a state that is contracting, and that is the case here. The corporate income tax rate is 6.5%, above the national average and above every neighboring state except Virginia and Maryland. The Tax Foundation notes that West Virginia uses what they call distortive tax credits for jobs, research and development, and investments, and suggests that foregoing those credits in favor of a lower rate on all corporate income would improve competitiveness. Well, that would be great, but what about dropping the corporate income tax altogether, like states like Florida and Texas have done? Well, with some exceptions, but that's the general idea. We'll come to that later. Credits benefit the businesses that qualify for them. In other words, only the companies that have the money to hire the lobbyists benefit from credits. Rate reductions, however, would benefit every business, not to mention eliminating the corporate income tax altogether, at least those taxed as corporations. West Virginia has consistently chosen credits over rates, which means the effective corporate tax environment depends on whether the business fits the criteria the legislature selected, meaning the politicians are picking the winners and losers. I'm sorry to break it to you, that is reality. Now, West Virginia does have some positives. For example, West Virginia does conform to federal bonus depreciation under Internal Revenue Code Section 168K and conforms to federal net operating loss treatment. Good. Those are good things. These provisions keep the corporate tax base more aligned with the federal code and reduce the compliance cost of maintaining separate state depreciation schedules. West Virginia does not yet impose a state level estate or inheritance tax. More good things. The effective property tax rate on owner-occupied housing is relatively low, and the public pension system is fully funded at 100%. That is a distinction shared by only a handful of states and eliminates one of the primary sources of future fiscal and tax pressure. So it's not all bad. But the debt tells a different story. State and local debt per capita is a whopping $13,160 per man, woman, and child. That is among the highest figures in the country, exceeded by only a few states, including New York and the District of Columbia. A state with a fully funded pension system and $13,160 in debt per capita has not eliminated or even come close to satisfying its fiscal obligations. It's merely engaged in some favorable accounting and creative financial engineering by moving them from one line item of the state balance sheet to another. That debt must be serviced, and debt service requires revenue. State and local tax collections per capita are moderate at $5,335, below the national average, which means the debt load, however, is high relative to the revenue base. A state that collects only $5,335 per person and owes $13,160 per person is carrying nearly 2.5 years of per capita tax revenue in outstanding obligations. That is a sticky wicket. Some West Virginia localities also impose gross receipts taxes called business and occupation taxes, the same name used by Washington State for its statewide gross receipts tax. The name is confusing and frankly misleading. These local level taxes apply to gross revenue regardless of profit, meaning you pay them even if you lose money. And they add a variable cost depending on where the business operates within the state. That is a headache. On $500,000 of pass-through income, to put this in perspective, 4.82% produces $24,100 in recurring annual state income tax. But if you were in Florida or Texas, that number would be zero. Over 10 years, the difference is nearly $250,000, and that is before we account for the time value of money. Now, with that context at the front of our minds, let us now shift gears and discuss redomestication. Redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax, but only when performed with the requisite formalities required by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. When executed correctly, that is to say, when performed by a competent, experienced professional, those are key words, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is no operational or financial operation disruption. Well, I guess I repeated myself there. Let me rephrase that. There is no financial or operational disruption, but only when you work with somebody that actually knows what they're doing. And that's a big win and a big if. Now, foreign entity registration. Foreign entity registration, also referred to as foreign qualification, is not redomestication. These terms cannot be used interchangeably. They mean different things. Foreign entity registration does not change the company's legal state of domicile. It does the opposite. In fact, it keeps the entity in West Virginia indefinitely and merely adds a second layer of compliance and tax obligations in the new state. Meanwhile, a traditional merger creates a new distinct entity in the destination state and can trigger serious tax consequences. Finally, dissolution should not enter the conversation at all. Dissolution terminates the company. There's nothing left to move. It is a we've failed and are going out of business mechanism, not a we are growing and relocating to a new state mechanism. It is not a relocation mechanism. If you have a so-called professional recommending dissolution or saying, oh, it's easy, just dissolve the company, please get advice from somebody that knows what they're talking about before you make an irreparable mistake. Redomestication, when paired with a change of personal residency and this is an important a reduction or outright cessation of business operations in West Virginia can reduce or even eliminate state tax exposure for the entity and its owners. Now, let's recap. West Virginia's pension system is fully funded. Good. Its debt per capita is $13,160. Not good. And the population is declining. The economy runs on coal and natural gas. The revenue triggers for future income tax elimination depend on growth that has not materialized and may never materialize. Meanwhile, better options like Florida and Texas are available. Some states, like Florida and Texas, impose no state level personal income tax at all, and most small and medium-sized businesses in these states pay no business income tax. You heard me right. Now is the time to consider acting before the West Virginia legislature changes the law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing LLC or corporation out of West Virginia or out of another state, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information illuminating. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this important information or the content of any of my many earlier presentations on these topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.